battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, put your hands together. Let's go, episode 200. We made it. Thank you for being here. This is the first podcast ever in Francesca's. This is also our first live podcast, so hopefully it won't be our last after today. So thank you for being here. Some of you have been with us since the very beginning. George and Pat, just wanted to call you guys out specifically. You have been with us, I think, almost every episode. You were there with us every single Thursday at 10 a.m. Thank you for being with us. And you guys don't know how much it means. You don't know how much it means to us that you're with us for these shows. We started this in the height of COVID when nobody knew what was going on. We had no clue what was going to happen. The world shut down like a light switch, and there were a bunch of question marks. We said, let's do a podcast every Thursday. Our first one, we had 12 people. And so now, as you look at the show, we've got almost 1,000 people watching the show every week, and that's thanks to you. Thank you for being here. So episode 200, we started this, and what do we say on the weekly show every week? We're battling the doom and gloom. Does anybody hear that every single week? Okay, so what are we going to talk about today? We're going to battle actual doom and gloom. I'm going to give you the 4 lies of investing that you have to watch out for. 4 things that you should be aware of, just in case you see these things over the next couple months and years. Don't panic. You've heard that before. If you watch the show, don't panic. But before we jump into it, 2026 Investor Day, coming up right around the corner. If you haven't registered for this thing yet, it's almost full. October 16th and 17th, 2025. This year, we're always forward-looking into next year in Oak Brook at Gibson's. You cannot miss this thing. It gets full every single year. Call Katie the Greek. We got Katie the Greek. Big round of applause over here. And you'll also recognize, right over here to my left, Producer O. So get on for 2026 Investor Day. Let's jump into a little bit. We've got to look at the past a little bit. We have to go back through the past 200 episodes, and I want to give you a quick version of where we've been. This was December 2nd, 2020, right in the height of the election season. We said, you don't invest in presidents. Half of our clients every election season are having a panic attack. The other half are very happy. And we said to that half, we said, don't worry. Things are going to be okay. The world is not going to come to an end. And what happened to the S&P? It went up 85%. Aren't you glad you stayed on your plan? August 11th, 2021, we said, what do you do when you're investing at all-time highs? The S&P was 4,500 at that point, and it went down 22% intra-year in 2022, but today it's at 6,455. Aren't you glad you stayed on your plan? October 14th, 2021, when Jerome Powell, our best friend, said that inflation was transitory. Remember the big T word, transitory. It's going to be here today, gone tomorrow. What did we tell you? No, it's not transitory. We told you inflation was going to be here to stay. If you were following Milton Friedman from the University of Chicago, who won a Nobel Peace Prize on this, said that as M2 money supply goes up, you print a bunch of dollars in the economy, what happens to the value of those dollars? They get pummeled. They go down. So some of our clients said, Nick, pizza costs more than ever before. What do I do? My pizza costs more. And I said, it's not that your pizza costs more, it's that your dollar buys less pizza. And that's what happened. CPI, consumer inflation, is up 4% a year every single year since. That is almost double what it was coming out of the financial crisis. Inflation is here to stay. Why? Because we printed money. We were on the cutting edge of this. We told you to go short-term on your bonds. December 9th, 2021, we said higher rates won't kill the bull market. We followed that up a few episodes later with these are not your father's interest rates. And we were right. S&P 500 was up 40% ever since then. October 6, 2022, markets down 23%. It looks like the world is coming to an end. The doom and gloomers are coming out of the woodwork, telling you to buy gold, guns, butter, and gold, and build a bunker in your backyard. You heard this. If you were watching your favorite TV show, you saw the commercials. I get my gold from Roslyn Capital. Who saw that, right? We said stocks are cheap. Don't panic. Stay on your plan. S&P is now up 79%. Aren't you glad you stayed on your plan? May 10th, 2023, We wrote about the banking crisis. This is when the sky was falling with SVB, First Republic, and ever since then we said, hey, big banks are strong. Don't worry, don't panic. The banking index is up 65% since May 10th of 2023. And my last one for you, February 29, 2024, we asked the question, is this a bubble? When the S&P was at a brand new record all-time high, we said no. And the S&P today is up 27%. So aren't you glad you come back to this show each and every week? Because where else are you going to get the clarity and confidence? Where are you going to get the good news? If you go watch our friends at CNBC, they are not incentivized to give you the good news. What are they incentivized to do? They are incentivized to scare the pants off of you and get clicks on stories. And they've learned that the scarier the story is, the more we click, the more we watch. If it bleeds, it leads. And we know that. And so what we've done is we've been consistent. If you've watched the show, there's one thing that you know is we are consistent. And I got a complaint the other week on the show, and this guy said, Nick, you just come out there every Thursday and say the same exact thing you always say. I'm like, well, what would you rather have me do? You want me to flip-flop every other week and tell you something different? No. I'm going to tell you the same story. Stay on your plan. So here's the Stenger Family Office S&P 500 index forecast the past couple years. Now, you have to remember, going into 2024, I want to show you 24 and then 2025, all of these leading strategists on Wall Street were extraordinarily bearish. They were just hunkered down, expecting the worst, expecting doom and gloom. And you had J.P. Morgan come out and say 4,200. You had Morgan Stanley at 4,500. You had Stifel there. You had Goldman Sachs, Bank of America. Everybody was sub 5,000 points. And at the time, we came out at Stenger Family Office, and we made the bold call in December of 2023 to say that the S&P was fair value 5,200 points. Well, we also got it wrong, but we got it wrong to the other side. And instead, the S&P ended the year in 2024 at 5,942. Wow. So now you're thinking these strategists are going to change their tune. They're like, we were wrong, so now we got to change so that we're not wrong again, right? No, they do the exact opposite. And at the end of 2024 for 2025, we came out, Stenger Family Office, for this year, we said 6,700. Anybody remember that prediction we made? 6,700 on the S&P. And then the market went down on April 7th to the lowest point it ever has been at this year. And everybody changed their tune. Everybody panicked. What do? We came back on the show every single week and told you the same thing. Stay on your plan. Here we are, a couple of percentage points away from the brand new record all-time high, which I do think we're going to hit this year, 6,700 points. Here's all our friends on Wall Street. Straight out of CNBC. Jumping ship. 4 more Wall Street strategists cut S&P 500 target on Trump's tariffs. Now, I know this is small, but if you can read this, what's the date? Somebody yell it out. April 7th. Now, let me show you a chart. You know we like data, math, statistics here on the Nick Stenger Show, okay? So what did we show you? We show you these charts. We show you the data. Anybody recognize anything there? When those strategists came out April 7th and said the world was coming to an end, does anybody see that little number there? April 7th was the exact bottom of the market. So the time that the media told you to panic, the time that all the smartest strategists on Wall Street told you to panic, was the actual best time this year to buy. If we did that, we'd be working here at Fuddruckers. So you have to distinguish, and I've called out the strategists on the show. I've made the difference because there are very good people at these firms. So don't hear me wrong. There are very good people at J.P. Morgan, very good people at Wells Fargo and Morgan Stanley. We work with many of them who are portfolio managers. And a portfolio manager is different than a strategist. A portfolio manager has to do one thing at the end of every single year and give you a report card. They have to show you how they did. And so that's why you should listen to people who actually manage money. These strategists have no incentive to actually keep you on their plan. They can go on CNBC on Monday and be bullish, and by Friday they're bearish. And nobody calls them out, except for me. I call them out every single week. Why? And why do we get amped up about it? Because they cost people real dollars. That's the reality. This stuff really does trickle into portfolios if you're not careful. So let me go through my 4 things to watch out for, the 4 investing lies. And number 1 is, of course, this time is different. And this is a chart of what happened during COVID. Everybody remembers COVID like it was yesterday. We all remember where we were. I was here, believe it or not. It was my birthday, March 1st. We were here having family dinner, and the news had just broken. We were actually in this room upstairs, and we just had the news break that COVID was here. And we all said, oh, it'll be over in 2 weeks. Remember? 2 weeks to slow the spread. Remember? Nope. Market goes down 35% in 3 weeks like that. Scary time. We thought the world was going to look radically different on the back end of this thing. We said there was going to be a new normal. Remember that term? The new normal. What do we tell you to do? We said, stay on your plan. Buy stocks. You're like, which ones? We're like, yes. And look at the stock market here. Even if you bought in at the absolute peak, you're like, oh my goodness, I really goofed up. I bought in at the absolute peak of the S&P in the 3,500 point zone right before COVID hit. But you just stayed on your plan and did nothing. Look at today. You're at 6,450. So, no, it's never different. This is going to pass. That's what we try to tell you. Look at all these stories. This is June 25th. This time is different for the U.S. economy. Harvard put out a survey. They say this time is really different. Jamie Dimon. We love Jamie Dimon. J.P. Morgan's one of the biggest holdings in the Stenger Family Office portfolio. Been one of our top performers. But Jamie Dimon, by nature, is a doom and gloom prepper. He is running the biggest bank on earth, one of the most powerful places on earth. He has to be a risk manager. That's just reality. That's what you want from Jamie Dimon. You want him to be careful and cautious and conservative. But if you look at his actions, if you actually look at what he's done at J.P. Morgan, he's an optimist. So be careful with these headlines. This time is different. You're going to see that. Here's another story from October 2024. Goldman Sachs forecasts a 3% annual return. We did the show Goldman Turns Bearish. You may remember that episode. You're going to see these stories. Well, let's go back. You remember I have my doom and gloom folder, all the stories where we keep screenshots of this. We keep the receipts so we can go back and call these people out later. Well, here's one. Vanguard. March 3rd, 2010, Vanguard said that real returns on equities are only going to be 6% versus 2%, maybe 0% for bonds over the next decade. It's been almost triple that. Well, here they come again. Stocks are roaring higher this year. This is August 6, 2025. But Vanguard says investors should stick 70% of their money in bonds. So just remember where we've been, because we like to look at people's track records. If they've been wrong consistently, like, for a decade, we'd be like, yeah, we're probably not going to listen to you anymore. That's where we're at here in this cycle. So here's all the bad stuff that's happened over the past couple hundred years. And each and every time, strategists and pundits have said, this time is different, the world's coming to an end. And we invoke Scripture on this podcast once in a while, so I'm going to give it to you tonight. Why do we bring up Scripture on the podcast? Well, I believe that is the true source of where all wisdom comes from. So let me give you a verse straight out of Ecclesiastes, and if you've been watching the show the past couple episodes, you've seen this. This is written by the wisest man to ever live. What has been is what will be, and what has been done is what will be done, and there's nothing new under the sun. Have I not been telling you this on the podcast? Oh, this time's different. Really? You want to argue with that? That's why we bring this up. So everything I'm telling you is based in this kind of perspective. That's the key. Here's Northeastern University, just did a study. 93% of human behavior is predictable. We're financial advisors. We can tell you we've lived this. Okay, here's the cycle of human behavior with investing. Number one, you're pessimistic. Then things get really bad and you panic. Then you're in despair. You're like, oh, things are never going to get better. It's never going to be good again. Then things get a little bit better, but you deny it. You're like, no, this is a dead cat bounce. This isn't really real. This isn't going to work. And then all of a sudden you get optimistic after missing like the first 50% of the rally. And then at brand new record all-time highs, when people feel euphoria, that's when the markets peak and it's the worst time to buy. And I just show you this quote from Sir John Templeton, who said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. We are nowhere close to euphoria in the stock market today. Yes, there are pockets of AI that are in a bubble. I covered that last week on the show. I said the AI bubble, yes, there are companies that are more pricey than the tech bubble of 1999. And you got to be careful with those companies. Watch out. You could be left holding the bag. There's a company called Cisco that still is not back to its record all-time high in 1999. Great company. But if you pay the wrong price for a great company, that's euphoria. You may not see a return for a very long time, if ever. So be careful when you're buying. But the reality is this time is not different. These markets go in cycles. Number two, investing lie. Number two, stocks are riskier than bonds. This is a chart of volatility. You've heard the saying today that things have never been worse than they are right now in the stock market. Things have never been more bubbly than they have been before. Things have never been more volatile than they are right now. You've heard that, and it feels like that. You see these swings up 1%, down 2% one day, down 5%. You could see that. Well, in reality, volatility is a part of investing. So since 1950 now, we've had 71 5% corrections. We've had 26 10% corrections. We've had 11 20% corrections, 6 30% corrections, and 3 40% corrections. So what does this chart tell you? It's very common. You are almost guaranteed in the stock market that you are going to have a 5 or 10% correction almost every single year. So what do you do when you see a 5% drawdown? You can call me. That's fine. Give me a call. Say, Nick, talk me off the ledge. We will talk you off the ledge. That's our job. But what am I going to tell you? Don't panic. Stay on your plan. This is part of investing. Here's volatility in the 2020s versus long-term averages. We're actually lower with volatility today in the S&P 500 than we have been over the past 50, 60, 70 years. Squaring the data against the narrative. How about the Mag 7? You saw United Healthcare in the portfolio down 30, 40%, right? What have I told you? That's going to happen. You have 50, 60 companies. You're going to have one or two that are down. Well, guess what other companies have been down like that? Apple had a 31% drawdown in 2022. Amazon was down 52%. Google was down 44%. Meta was down 74%. NVIDIA is down 63%. Microsoft down 36%. Tesla down 73%. What'd you do every single time? Hopefully you bought more. If you're going to own the biggest and best companies, the reality is they're going to be volatile. So like Dr. Siegel wrote about in Stocks for the Long Run, over the long run, stocks, yes, are more volatile than bonds, no question, more volatile than putting your money under a mattress, but over the long run, it is less safe to be in stocks because of what? Because of the rising cost of goods and services, because of inflation. So over the past 200 years, Dr. Siegel studied it, stocks have produced a 6.9% annualized real return. Look at the dollar. Look at cash. I have a real story about this. This is my grandmother who started out with $1 million right before she went into a long-term care facility. Now, if you know somebody who's been in a long-term care facility, you know how much these things cost. She was paying $10,000 a month to start. By the end, she was at $14,000 a month. And we had her in all equities, 100% stocks. Now, we lived through some pretty scary times. We lived through Brexit, Grexit, COVID, the Fed raising rates, cutting rates, all this stuff. You want to know what she ended her life with after $10,000 to $14,000 a month? She still had $1 million left over. If she was in that bond portfolio, she would have been out of money after 4 years. That's the reality for investors. You got to be in equities. Here's what happens if you put your money under the mattress. Since 1950, you'd have literally $7 after putting in $100 of real buying power. Today, you'd have $2,800 in the stock market. So here's this is a great quote from Benjamin Graham. Benjamin Graham, if you don't know who he is, was Warren Buffett's mentor, wrote one of the best books ever written about investing, and he has this analogy of Mr. Market. Mr. Market doesn't always price stocks the way an appraiser or private buyer would value a business. Instead, when stocks are going up, he pays more than their objective value, and when they're going down, he's desperate to dump them for less than their true worth. Ben Graham also equates this to your house. Let's say you paid $400,000 or $500,000 for your house. Mr. Market walks by every single day. He just yells at a random price. It was 300,000, 500,000, 600, 200. When do you sell your house to Mr. Market? When you're ready to sell. Not because he's shouting out a random price. Warren Buffett followed it up with even a better quote. He said, Mr. Market is kind of a drunken psycho. Some days he gets very enthused, some days he gets very depressed, and when he gets really enthused, you sell to him. And if he gets really depressed, you buy from him. There's no moral taint attached to that. Watch out for Mr. Market. Just because Mr. Market's yelling out a price, saying the S&P is 5,000 or 6,000 or 4,000, doesn't mean you have to sell. You sell when you're ready to sell. Investing line number 3, you can time the market. You absolutely can not time the market. And if you've been coming to the show, I hope you, after 200 episodes, have heard me say this now. You cannot time the market. Repeat after me. You cannot time the market. Okay, every year, 2 people try. It never works. I had one person who got out on Thursday, right after the tariffs were announced, right before April 7th, like we saw in that chart. They listened to the show over the weekend where I kind of called them out. I didn't say their name or anything, obviously, but I said somebody panicked, and that was really not a very good idea. They listened to the show on Saturday. On Monday, they called me, and they're like, Nick, we listened to the show. We got to get back in. Okay, those 2 days cost them $87,000. This is real. When I tell you you can't time the market, you cannot time the market. We had somebody who got in at 5,500. The S&P went down to 5,200. They panicked and sold, couldn't handle a small correction, bought back in at 6,000. Don't time the market. Here's what happens if you try. So if you're invested completely across the cycle since 1950 and you're just in the S&P, you're not trading, you're not timing, you're not trying to get in and get out, you made an 8.3% annualized return. If you missed just one day, the best day of the year, because the way the market works is it may go down 5% one day and up 10% the next. That's very common. If you miss that one really good day, your return is 4.8%. Does anybody know when that good day is going to be? I absolutely do not. If you miss the best 5 days of the year, which, remember, are clustered very closely together, your return was negative 4.3%. Don't time the market. Here's what happens if you just had $1,000 invested since 1950 and just held on. You'd have $18,000 today versus trying to sell every time there's a 5% pullback. Remember, it happens every year. And then buying in at the new high, you're at $3,400. Here's a great little meme I saw. I don't always know when to hold them, but when I do, I also know when to fold them. You are not going to know when to do both. That's the problem with market timing. So you might be right on the way out. And you may say, Nick, you were wrong. I was right. I got out at the all-time high. The problem is you got to be right twice and know when to get back in. And statistically, that's very hard to do. Okay, number 4, investing line number 4, the future is going to be worse than the past. And this is where I adamantly disagree. I think this is the number one lie truly of investing. Here's Newsweek magazine, January 19th, 1981. They wrote a front page story, The Economy in Crisis, Why It's Out of Control and How to Fix It. The Dow was trading at 971 points. The S&P was at 133. The Dow today is at 45,400. If you read that story in 1981 and you believed it, you might never have invested for the rest of your career or your retirement. I'm telling you, you're going to see a story like this every single year, multiple times per year. There's always going to be a new reason to panic, a new reason to sell. Every year is going to have 10 reasons. And then I'm going to call you for our check-in call, and I'm going to say, do you remember why you were panicking last year? And you'd be like, no. And I had one client we did this with, and I said, do you remember why you were panicking? And he's like, no, I have no idea. I go, well, you thought that North Korea was going to nuke us. This is in 2018. You thought we were going to get nuked by North Korea, and we were going to get wiped off the face of the earth. And I said, if that's true, your investment portfolio is the least of our concerns. So watch out for these stories. So let's talk about all the good news. Let's talk about what's going on behind the scenes of the U.S. economy, structurally, why the bull market will continue. You've heard my pitch on the 3 reasons the bull market will continue. Let me recap them quickly. We've got baby boomers. Baby boomers, anybody in the house? Make some noise. All right. We got millennials. We got some millennials. Any man buns out there? No? All right. And then we got Gen Z. All right, so the first two structural pieces of the bull market are millennials and baby boomers. Baby boomers are retiring at $10,000 a day, and what do you do when you retire? Do you stay at home and just sit around and watch TV? No. What do? You travel. You go on cruises. You go on a Viking River cruise in Europe. You go. You want to hang out with your grandkids every day, so you're taking them. You're giving gifts to your kids. You're giving gifts to your church. You are out there like never before, and what are you doing? Spending money. Millennials. What are the millennials doing? They're making more on an inflation-adjusted basis than any other generation before them, despite what the media tells you. If you heard what some of these millennial starting salaries are, you'd fall out of your chair. Millennials are doing what? They're out there spending money. And then the third piece of the bull market that I think is structural and will be around for a long time is the explosion of the middle class in the emerging markets. We are watching like never before people get lifted out of abject poverty at a record pace. And what are they doing as soon as they go into the next class? They want all the stuff we have. They're spending money. This is structural. Let's talk about oil. We're going to spend a little bit of time on oil here. And why do we have to talk about oil? Because if you don't have energy security, you don't have national security. And here is this guy, Hubert, who in the 70s said we were going to have this thing called peak oil. You've heard about peak oil. He drew this little chart. That's the dotted line on the bottom. And he said right around somewhere in the 70s and the 80s, we were going to peak out on oil, and the end is near. Remember, this time's different. We're never going to have enough oil. The blue line on top is the actual oil production of the U.S. up to today. We've got enough oil. In fact, the U.S. today has more oil reserves than almost every other place on earth. 1885, again, nothing new under the sun. The state geologist of Pennsylvania warns that the amazing exhibition of oil is only a temporary and vanishing phenomenon. John Archibald, John D. Rockefeller's partner at Standard Oil, sells some company shares at a discount, fearing that oil is going to run out. And then this little thing called fracking happened. All across the U.S., we have unlocked and unleashed U.S. energy independence at a record pace because of technology. So what do I always tell you on the show? What drives innovation? What drives productivity? What drives companies forward over the long run? It's entrepreneurs inventing new stuff. And because of that, the U.S. has the cheapest energy prices for the most part out of the rest of the developed world. You go over to Europe, and our friends in the UK, we just had a Reuters energy columnist on our podcast on Bullish. You go watch it on YouTube. And he says in the UK right now, you're paying $8.90 for a gallon of gas. Germany, you're paying $7.22. You know, the nation of engineers, the Germans. Our family's German. I can say this. The Germans have lost their way. Why? Because they haven't gotten one thing right, and that's energy. How are you going to manufacture stuff if you don't have energy? You're toast. So here's what Germany is turning to. Talk about environmentally friendly. They are burning wood. Not good for CO2. And you just look at the data and you say, who's increasing CO2 production? It's China. And look at us here in the U.S. We are cutting, while our economy is at record all-time highs. How has that happened? Because I've got clients from ExxonMobil, we've got clients from BP, Shell, and Chevron. And what are they doing? They go to work every single day. They don't like carbon emissions either, just like us. They want to live in a cleaner world. They don't want to go outside and be like China, where it's like smoking 3 packs of cigarettes if you go for a run. And what do they do every single day? They put their heads together, they crunch the numbers, and they say, how do we fix the problems that we have? And they've done it. Look at the data, absolutely astounding. You should just get excited. I mean, look at global life expectancy now. Since 1900, global life expectancy is double. More than double. The share of people in the world living on less than $2 a day from 1820 to 2017, that's the latest we have the data on this, absolutely off a cliff. I mean, do we not get excited about this? Where is this on CNBC? Stomach cancer death. Yes, people are getting diagnosed. We all know somebody who's been affected by cancer. We've all lost somebody to cancer. We're finding it faster. But what are we also doing? People are living longer than ever before. Mortality is plummeting. All cancer mortality across the world is dropping. And who's on the cutting edge of that? Entrepreneurs, innovators. Here's global GDP over the long run. Like nothing. From 1 AD to this most recent couple of decades, almost no growth in wealth. And where are we at today? What has that done? Why do we have poverty at the lowest point? Why do we have cancer getting solved? Why do we have the best innovation we've ever had? Look at U.S. innovation. This is from LPL Research and Bloomberg. U.S. innovation has never been at a record all-time high. Where do all these people live? Where do all the billionaires live? This is a study of all the billionaires by country. The U.S. has 902 billionaires out of about 3,000. We have about 30% of the world's billionaires, and we have 4% of the world's population. Are you not amazed by this? I mean, this is astounding. This is incredible. All of the best and brightest minds are right here. All of the best Chinese, all the best Japanese, all the best Indians, all the best people from Latin America and Africa, everybody is right here. And they're in your portfolio. I mean, this is incredible. That's why I told you, just buy U.S. companies and don't go anywhere else. Absolutely incredible. And what do our entrepreneurs do with that money? Anybody heard of the giving pledge? These billionaires who are going to give everything away before they're gone, or most of it away? The U.S. is the most charitable country on earth. You think, oh yeah, all this capitalism, all this wealth, all this GDP, and what's happened? Well, in 2023, we gave $557 billion to churches and charities. Absolutely astounding. So that's what I want to turn your attention to on the show. That's why we keep coming back here every week, because you're not getting this from the relentlessly negative doom and gloom. And so when we add it all up and we look at the 4 lies, this is how we battle them. Number 1, this time is different. What do I always tell you? This too shall pass. Number 2, stocks are risky. My answer to that is not being in stocks is risky. Number 3, you can time the market. You absolutely cannot. Market timing is a fool's errand. And number 4, the future will be worse. I say the future is exciting. I go back to Ecclesiastes. Let me give you one last one before we close out. Ecclesiastes talks about how because the future is uncertain, human nature would say, that's scary. Right? We don't know what the future holds. We don't know what happens in 5 years, 10 years, 20 years. I say the opposite. And this is what Ecclesiastes says. Because the future is uncertain, we ought to be excited. I mean, we absolutely should be amped up and pumped up and optimists. Why? Because in your wildest imagination 20 years ago, did you ever envision AI? Did you ever envision the cloud? Did you ever envision high-speed computing? Did you ever envision that we would be solving cancer at record pace? Did you ever envision that we'd be where we're at with innovation today? No, because if you take a bunch of communists and you put them in a closed room, their best answer to a horse and buggy is a faster horse and buggy, not a car. They're not innovators. They're not entrepreneurs. And so if we get the entrepreneur to the forefront, like we've done in the U.S., and we let them thrive, yeah, we got to have rules and red tape and stop signs and all the rest of it. But if we let the entrepreneur thrive, you're going to see this continue, all the stuff that we want to see. So stay on your plan, stay optimistic, stay bullish, and do not panic. I think we're headed to 6,700 on the S&P a lot faster than you think. Don't miss Investor Day 2026 coming up October 16th and 17th. Thank you for being on for episode 200. Thank you for being with us in person, and we'll see you next time for episode 201.